looking at ImmunityBio, ticker symbol IBRX, as of today, April 15, 2026, is this stock caught in a falling trend, flashing massive sell signals, or is it a fundamentally undervalued powerhouse hiding a massive upside?
That is the million-dollar question right now.
Right. I mean, we're unpacking one of the most polarizing setups in the biotech market today. So while you pull up the chart on your end, take a second to hit the like button, subscribe to our YouTube channel, and leave a comment with your feedback below.
Yeah, we really want to hear your read on this as we parse through the data. Your perspective in the comments is crucial because, well, the market itself is entirely split on this company.
It's completely fractured. So let's establish the baseline. Today, IBRX closed at $7.78.
Which is about a 2.37% gain for the session.
Exactly. And on the surface, it looks like a standard green day. But if you zoom out and look under the hood, the mechanics of this stock are incredibly complex. We're looking at a market swinging wildly across its 52-week range.
Right, from a low of nearly $4 all the way up to $11.50.
Yeah, but before we dissect the mechanics behind those swings, we need to establish that this deep dive is an impartial analysis of the sources provided. We're looking at market data, financial statements, and public filings to foster a natural debate of the facts.
Absolutely. Just a reminder, this is not financial advice. We aren't recommending you buy, sell, or hold. The goal here is just to help you understand the forces driving the valuation.
Okay, let's unpack this. To understand why ImmunityBio is priced the way it is today, we first have to look at who is actually holding the shares. And the ownership data reveals an absolute standoff.
A literal Wall Street tug of war.
Yeah, exactly. It's like a high-stakes poker game. You have the insiders, the founders, the executives, people running the clinical trials, and they own roughly 70% of the company. They're completely all in.
70% is a massive chunk.
Right. But then on the other side of the trade, half the table is aggressively betting the company will fold. The short interest sits at a staggering 43% of the public float. Why is there such a massive disconnect?
Well, the mathematical tension there is just incredible. When insiders hold 70% of a company, they're restricting the supply of available shares.
Which usually signals immense confidence, right? Like, they believe in the long-term vision, so they aren't cashing out.
Exactly. But the public float, the remaining shares available for everyone else to trade, is already this small pool. And of that restricted pool, nearly half has been borrowed and sold short by traders, betting the company is going to fail.
It's crazy. Usually when insiders hold that much equity, it scares short sellers away. I mean, the risk of a short squeeze is just too high. So why are the bears so aggressive here?
They're aggressive because they're looking at the runway. They think the company is going to starve before the gold mine ever pays off. It really comes down to market sentiment, which right now is actively shifting.
Shifting how?
Well, it was registering as greed, but it's currently sliding toward cautious optimism. Investors are weighing these two extreme sides against each other.
So the short sellers see a ticking clock on the balance sheet, while the insiders believe their flagship drug will scale fast enough to save them.
Precisely, which brings us directly to the financials. If we want to know who's going to win this standoff, we have to look at the money coming in versus the money bleeding out.
And the numbers here are, well, they're completely split. On one side, you have undeniable explosive growth. I mean, looking at the annual income statement, fiscal year 2025 revenue surged to over $113 million.
That is a 668% increase year over year.
668%. And preliminary Q1 2026 revenue is pacing at over $44 million, largely driven by strong sales of their drug, ANKTIVA.
Yeah, and a 668% revenue jump is not theoretical. That's the kind of metric that proves a biotech company has crossed the chasm from, research and development into actual commercial traction.
The drug is in the market and the revenue is arriving.
Right. For growth investors, that top-line growth is a massive validation.
It is stellar. But,
yeah.
And here's the massive but, the cost of generating that revenue is staggering. Despite bringing in $113 million, their net loss in 2025 was over $351 million.
Yeah, leaving them with a trailing 12-month earnings per share of negative 38 cents.
But the margin disparity is the piece I really want to dig into. Their gross margin is 99.34%. It's practically flawless.
Almost perfect.
But their net margin is deeply negative, minus 310.25%. Like a highly successful lemonade stand where the lemons are practically free, but the owners are spending millions on advertising and legal fees, and it's just sinking the business.
That's a great way to put it. It highlights the brutal reality of commercializing a novel therapeutic. In the pharmaceutical industry, a 99% gross margin just means the physical manufacturing of the drug costs almost nothing compared to the price they sell it for.
Right, like a blockbuster movie. Distributing the digital file to theaters costs nothing. That's your gross margin. But spending $500 million to film it, market it globally, and pay the lawyers, that's what sinks the studio.
If we connect this to the bigger picture, that negative 310% net margin shows the crushing weight of everything else. The operating and R&D costs are immense. It's the cost of massive clinical trials, building out a global sales force, and administrative overhead.
They're generating $100 in revenue, but spending over $400 to keep the enterprise running.
Right, and when you look at the balance sheet and cash flow, the gravity of that spending becomes a very real, very dangerous problem.
Let's look at the liquidity. Total cash for the most recent quarter is roughly $242 million. Total assets are sitting at around $501 million.
But their total debt is a towering $518 million.
Meaning, when you net that out, they have a negative total equity of roughly minus $499 million.
Yeah, and that negative equity is the foundation of the entire bear case. Liabilities completely dwarf assets. Plus, if you look at their levered free cash flow over the trailing 12 months, it's negative $213 million.
Wait, negative $213 million? That's the cash leaving the business after paying financial obligations.
Exactly. If you're burning over $200 million a year and you only have $242 million in the bank, your runway is incredibly short. This means the company will likely require continued debt or equity financing to survive.
Creating serious financial instability. So they have roughly 1 year to figure this out before they run out of money.
Pretty much. And when a company is in that position, they can't sustain themselves organically. They either take on more debt at punishing interest rates, or they issue new shares of stock to raise cash.
Which dilutes the current shareholders, making every existing share worth less. And short sellers just feast on dilution because it naturally drives the stock price down.
Exactly. That need for constant financing explains part of the short interest.
Here's where it gets really interesting, though. Because there are deeper structural risks pulling the stock down. Is IBRX truly undervalued, or is it a classic value trap? The downside risks involve severe regulatory and legal hurdles, right?
Yes, based on the source material, the FDA recently warned the company about false or misleading claims regarding cancer cures.
That's a huge deal in biotech.
It is. The FDA strictly controls how a drug's efficacy can be communicated, and it's compounded by an ongoing class action lawsuit alleging securities fraud based on those very same misleading efficacy claims.
So let me pose a scenario. Don't retail traders often get blinded by that 668% revenue jump? Like they jump in completely missing the FDA warnings and the negative equity. Is this why retail traders often get trapped?
Oh, absolutely. That thought process is the textbook definition of a value trap. Retail investors often misjudge the volatility and downside risks of regulatory scrutiny. They confuse a cheap stock price with a safe discount.
Because an FDA warning isn't just a speeding ticket. It's a threat to the core product. If oncologists think the efficacy data is exaggerated, they'll just stop prescribing it.
Right, and that revenue growth you saw last year can just evaporate over. Plus, lawsuits drain the one thing the company desperately lacks: cash.
Okay, so the bears are looking at a cash-strapped company facing an FDA warning, a fraud lawsuit, and inevitable share dilution. Sounds pretty bleak.
It does.
But let's look at the bull case. If the bear case is so legally perilous, how do we explain the 70% insider ownership? Or the massive price targets from analysts? I mean, the average consensus right now is Ahold ranked number 3.
Correct.
Yet the average 12-month price targets are sitting between $14.80 and $15.10.
Which is nearly 100% upside from today's closing price.
Exactly. But then look at the valuation. The price-to-sales ratio right now is almost 69. The industry median is 6.76. How can analysts justify a $15 target when the company's trading at 10 times the industry median for price to sales? Technically, it's overvalued on current sales alone.
Well, what's fascinating here is that analysts projecting a $15 target aren't modeling today's reality. They're looking at a best-case recovery scenario where ImmunityBio achieves a global monopoly.
Ah, okay.
The market is attempting to price in strong ANKTIVA momentum with expanding global approvals. They just got approvals in the EU and Saudi Arabia.
So they're betting the 668% growth is just the opening act. If ANKTIVA becomes the undisputed standard of care globally, A PS ratio of 69 today might actually look cheap later.
That's the bull thesis, yes. If they can clear the legal smoke and scale international sales faster than their cash burn, the high valuation is validated. But there's a secondary mechanism driving that
It's
target.
a short squeeze.
Exactly. That 43% short interest creates the perfect conditions for a massive short squeeze if positive data drops. If they announce a favorable legal ruling or a surprise trial success, the stock jumps. Short sellers start losing money and are forced to buy shares to cover their bets.
And because insiders are hoarding 70% of the company, there aren't enough shares to go around. That forced buying drives the price even higher.
Exactly. Analysts factor that squeeze potential into their price targets. It's the best case recovery scenario versus the worst case continuation lower.
Okay, so with the fundamentals so fiercely debated, we have to consult the charts and the order flow to see what buyers and sellers are actually doing right now. So what does this all mean?
Well, the charts tell a very specific story about the trend direction. If we look at the 52-week context, the long-term trend is bullish.
Right, it's up roughly 180% in 1 year, bouncing from that 200-day simple moving average low of $3.92 up to a long-term ceiling of $11.50.
But, and this is key, the short-term trend has recently turned negative. We're seeing short-term weakness.
Are the technicals confirming the bears or just showing a stock taking a breath?
I would describe it as a state of consolidation. Let's look at key support and resistance. There's key support at $7.49 and another zone between $7.17 and $7.31.
And the major floor is down at $6 flat.
Right. Meanwhile, immediate resistance is right above our current price at $7.80 to $7.90. The stock is just trapped between these levels.
And the momentum indicators are totally mixed. The RSI, the Relative Strength Index, is neutral, sitting around 47.25 to 48.58.
Which means the stock is neither overbought nor oversold. It's holding its breath.
And the MACD is flashing mixed to negative signals, right? Ranging from a slight bearish minus 0.06 to a late buy recovery signal of minus 0.25.
Yeah, and it's experiencing that short-term weakness by trading below the 20-day simple moving average of $7.37, but it's still resting safely above the 200-day SMA.
So it's literally trapped between its moving averages. What about the order flow? Who's actually buying and selling?
It's fluctuating wildly. We saw a large $6.58 million inflow on April 8th. But just a few days later, on April 13th, there was a net outflow of negative $650,000.
Big money is stepping in, looking around, and then pulling out. The market is completely hesitant, waiting for the next major news catalyst.
That's exactly what consolidation looks like.
So bringing the immense scale of this tug-of-war directly back to your perspective as the listener, how do we summarize the outlook here?
If we break it down, the short-term versus long-term outlooks are vastly different. The short-term is dominated by chart weakness, volatility, and legal headlines. You have negative signals and a cautious market.
And the long term.
The long-term hinges entirely on ANKTIVA's true global efficacy versus the company's crippling debt. It's a race between achieving standard of care status and running out of cash.
Which leaves us with a lingering uncertainty. With the charts consolidating and the fundamentals so fiercely divided, the real catalyst might actually be hidden in the calendar.
What do you mean?
Well, would examining the specific clinical trial dates for IBRX's upcoming pipeline readouts be the key to predicting the next big swing? Because when a stock is this tightly coiled, a single data drop could ignite the squeeze or confirm the value trap.
That is a very interesting point to consider.
We want to know what you think. Do your own research on those upcoming dates and let us know your thoughts. Don't forget to like the video, subscribe to the channel, and drop your feedback in the comments below. Keep exploring these questions, and we'll see you on the next deep dive.